Yo, what's up, guys? In this video, we're going to be going over 3 dividend stocks that I think you should buy. And these aren't your traditional dividend stocks. These are actually REITs, and they have to pay out their dividends by law. And that makes that super attractive for us dividend investors. But we're going to be analyzing them from a financial fundamental point of view, and we're going to be looking at important metrics like the AFFO. Some new investors look at metrics like the net income, which you would look at for traditional dividend stocks, but you don't want to look at for these REITs. So we're going to compare the AFFO to the dividend, and we're also going to be doing a multiple on the yearly AFFO to see how expensive or how cheap they are, and then compare that to their competitors to get an idea of how they're valued. All right, guys, so the first dividend stock on the list is actually American Tower Corp, ticker symbol AMT, and I have some surprising facts that I bet you didn't know about this company. But the dividend yield right now is 3.33%. Now, that may not seem very high, but I'm going to show you why. They have tons of room to raise the dividend, but if you notice, they actually just cut their dividend from $1.70 to $1.62 or back to $1.62. In my view, that's because they actually sold off $2.6 billion worth of cell towers to ticker symbol BAM or Brookfield Asset Management. All right, so right here is the number we actually want to look at. This is the core FFO, and in the most recent quarter, they made $1.28 billion, which is actually up 19% year over year, which is a really good growth rate. But check this out. Let's do a dividend payout ratio off this. So they made $1.28 billion, and their dividend from this literally cost $802 million. So that's why I'm saying they have a super safe payout ratio, and they actually have a lot of room to raise their dividend. And this is what I love about the company. They're actually not diluting you at all as a shareholder. So you've actually only been diluted 0.18%, which is literally nothing. And they're not diluting you because they have a lot of debt, and that's the same amount of debt they've had for a long time. It's very sustainable. Remember, they made $1.28 billion in one quarter. Think about how fast they could pay it off if they wanted to. And the company also has $2.39 billion in cash, which is amazing. But now I want to show you the revenue segment breakdown. So check this out at the top here. Just look at the orange in specific. Look at 2019, the orange, this was Africa, for example. Look how much it's grown. And you can even compare the numbers down here from 2022 to 2023. And every segment is up, but America has been slowly growing. But look at all the new segments they've been adding. All the other parts of the world that they're invested in are growing like crazy. So they're called American Tower Corp, but as we can see, only half the revenue comes from the United States and Canada properties. So here's American Tower Corp's AFFO ratio. It's a 15.34, and they calculate this just off the trailing 12 months AFFO of 12, times that by 15, and that's the current share price. And this is Crown Castle, which is basically their biggest competitor, and that's at a 14. It's a 13.38. You can do the calculations there, but yeah. Now let's get to the next REIT. All right, guys, so the next REIT on the list, I think it's going to do insanely good. So not only in stock price appreciation, but in dividend growth as well. They have a lot of room to raise the dividend, in my opinion. Not financial advice, but look at the dividend growth on this company. Like in 2020, it was $1, and now it's $1.47. And the yield is 4.27%, and that's the yield right now. And they're going to raise it, I think, a lot. And let me show you how much they can raise it. So right now, their dividend cost $1.47, and they're making every single quarter well above that. In the most recent quarter, it was $1.71, but Q1 is always when the apartment REITs don't have their best quarter. Q2, look at this, they made $2.87, which is well over $1 above that. So they have so much room to raise the dividend, and let me visualize that. Oh, look at their balance sheet. Look how safe they are with a 45% asset to liability ratio, but look at the number down here. So let's not give them the benefit of the doubt. Let's take the $200 million they made in the most recent quarter and not look at their best quarter. We're not going to average it. So let's take $200 million in the most recent quarter, and their dividend from this cost $172 million, and it went up in the most recent quarter because they just rose their dividend. But the point is, they can still easily afford the dividend even on their very bad quarter. And if we look at their diluted weighted average shares, this is another company that has not been diluting you at all as a shareholder. All right, so now I want to show you a slide from their investor presentation. I didn't know this about the company. They're actually a member of the S&P 500. They have total 102,000 apartment units. They've been public for 30 years, and they're credit rated by Moody's and S&P Global. They're A rated, which is the best rating. And they have a net debt to adjusted EBITDA of 3.6x, which this is the ratio you want to look at for debt for REITs, and Realty Incomes is around 4. But let's actually go through this together because it's super impressive. You can see the peer average versus MAA, and the dividend growth of this company is super impressive. So this part right here is super important. This is talking about their debt and their balance sheet, and they're actually one of 8 public REITs to be A-rated or above. But the most important part is down here, that 95% is actually at fixed debt. I worded that weird. 95% fixed debt to protect against higher interest rates. So you definitely don't want to have the floating rate debt, which means your debt rate, interest rate is just whatever the market is. And here's their core FFO payout ratio of 66%. They calculate this themselves, and we can see their total debt. So all of their debt combined, the average interest rate is 3.6%, which is very impressive, especially today. This last dividend stock on the list has a very impressive high quality portfolio of tenants, but also I forgot to mention this company pays monthly dividends. So who doesn't want that? They are a triple net lease REIT, which is a very profitable structure, and their dividend yield is 4.96%, so basically 5%, and I'm going to show you why. They actually have room to raise it. So their dividend right now is actually a quarter. It's 25 cents. So this will make the math easy. So their dividend costs 25 cents, and they make every single quarter around $1 or just over $1 sometimes. But remember, they pay monthly and this is quarterly. So we got to do 0.25 times 3. So their dividend costs 75 cents a quarter. So their dividend payout ratio is 75%. And we can actually visualize that with the numbers, and also look at how safe this balance sheet is. It's just monstrous. But let's check out the numbers right here. $103 million in the most recent quarter. So $103 million, and their dividend from this cost $76 million. So just like we just saw, right around the 75% payout ratio, which is very safe and I love to see. So here is the company's investor presentation where they're talking about their super high quality tenants. These are their top tenants, and check this out. These are all publicly traded companies that are very safe and reliable. Actually, all of these top 6 are all publicly traded, which is kind of crazy. We can see that Walmart 6%, that stock's at all-time highs. Tractor Supply Co's at all-time highs, that's 5%. And 68% of all these tenants are actually investment grade, so they have a credit rating from S&P Global and Moody's, and their net debt to EBITDA is 4.8x and a forward 4.3x. And we can see the revenue breakdown, or the segment breakdown, like grocery stores, tire, auto service, but we can see the actual companies that are investment graded right here, like Lowe's, Costco, Home Depot, all these very popular companies. And we can see that they're definitely not over leveraged right now. The ratio has basically been where it's been at since 2021. So those are some cool stats that we can see. And they have a growing, well covered monthly dividend, 147 consecutive dividends paid, average AFFO payout ratio of 76% over the past 10 years. So you got to love this company. Let me know what your thoughts on them are in the comments. I'm going to respond to every single comment, but thank you guys so much for watching. If you hate inflation, then you need to download the Moomoo Investing app. You'll get 5.10% APY on your cash, FDIC insured, no hidden fees, and if you deposit $100, they'll give you a bunch of free stocks. They'll give you a free share of Nvidia, Google, Tesla. Don't you have an Nvidia graphics card? Why not own some of the company? If you want to learn more, check out the end screen up here or download it now with the link in the comments and the description.